Hello, good morning, fellow traders, and welcome back to Von C with Traders. Today, we're just going to talk about a very good topic, talking about support and resistance and the Fibonacci. So that's what we're going to talk about today. And thanks to Gpunk, you can follow JP on Twitter. So it's at JEPUNK, who's actually helped us with the slides. He has sent his slides over. So that's what we're going to talk about today. So as you know, we're not brokers. Find JP on Twitter. And whatever we discuss here does not constitute trading advice. So here we are. So what is trading? That's what we're going to discuss here. So it involves, as you know, we buy and sell shares on the stock market, depending on which market you're trading. And of course, most of the time, we want to sell our stocks for profit, and that's why we're trading, to be quite honest. And there's also a process called investing, whereby it's the process of buying an asset or an item acquired with the goal of generating income or appreciation. So, for example, most investors use this method. They actually purchase a monetary asset. Now, of course, the idea is that the asset will provide income in the future or later on when they sell and they sell for profit. Well, as you know, there are some people who do this blindly, and now, of course, that's going to be called gambling, as has been noted there. So, yep. So you can see that they clearly. And the key difference now is trading. We don't generally care what the product does or how beautiful the products are. So trading is also a mindset. So always think in terms of risk. So, as you know, you must be risking what you can afford to lose. So, don't just be trading blindly there and not knowing what you're doing. So, you need to be looking at what price you're going to buy when you're looking at stock trading, and as well, put some stop losses there because you want to know, what level will you sell when the price starts going against you, because this happens quite often on the market. So you need to ensure that you put your stop losses in place. So make sure you respect them and adhere to them. So just remember that trading is not a marathon, not even a race. We aim to play for long term. So there are various trading methods. And the main two ones, of course, is technical analysis and fundamental analysis. So technical analysis involves the process of evaluating a stock by the use of charting platforms, by noting apparent price action patterns that occur as a result of people buying and selling. So usually, if you're looking at TA, it provides a much more quicker analysis. And then you've got fundamental analysis, of course, which is the process of evaluating a stock by studying the project, the financial statements. We noted this before. If you look at the other previous slides as well. So the country's GDP, other factors around, including any speculation going on. This approach usually takes longer and it requires you to do quite a lot of research. I know most traders don't like this part, but you have to read, because if you don't read, you won't make it on the market. So if you are interested in using FA purely, yeah, that's fine, And if it makes sense to you, fine, that's okay. So you need to just be able to choose which methods works for you. At times, you can combine both methods. They still work. So most traders always ask this question, what is the best methods of trading, to be quite honest. So there's not like a quick answer to this one. So it just depends on yourself, how you look at stocks, how you evaluate these stocks, so you can't just say, there's one way of trading, because that doesn't happen. So both the TA and the FA that we talked about has got its own advantages and disadvantages, of course. So the FA traders are more giving in terms of stop loss and generally not worry too much on the daily price movements, because most of them are in there for a long term, that sort of thing. So, however, as you can see there, JP uses mostly 80% TA and 20% FA. And his reason is TA enables him to quickly evaluate a stock price. If the price is a good range, then, it will have some good setups. But however, as he acknowledges there, that FA is also important for For example, if the chart looks good but the story, the projects etc do not align, he usually skips the stock. So that's why he's put that 20%, because he does consider the FA of the stock. So you can't just ignore that completely. So now here, the best method of trading. So firstly, you need to have some knowledge of technical analysis by the use of using charts. So you can't just go in there without looking at the charts, thinking things are going to go that way or that way, because this is not guesswork as well. I know it's guesswork. We're all hoping. It's not like if you read some TA and FA, you'll actually be in a better position than somebody who hasn't looked at those. So you have a trading plan. You have a strategy. Before you take any position, you need to have an exit plan. If the price goes against you, what are you going to do? So also have some trade management. Think in terms of risk. For example, ABC is at 1 cent and you want to put $1,000. Think how much you'll be willing to lose out of that $1,000. And also, losses are normal, but always try to minimize these losses, because you'll wipe out your whole portfolio if you don't. And you need to have some emotional stability when that price is going up and down. Are you going to be able to bear that every day? Are you going to drive yourself nuts? So cut losses and let the winners ride. As you can see there, I know it's hard sometimes because traders will look at their losses, stay in red, but sometimes if you move it to another stock, you can make some money. But it's not easy, because you'd have had to have researched quite a lot to see which stock is going to run after you actually sell the other one at a loss. And as well, don't over trade. Only pick the best setups to take positions. And as well there, sometimes you get distracted by going to certain trading platforms. I'm not going to name them, but just know what you're doing when you get there, because sometimes people just want to pump some stocks. So you don't want to be the person that's going to be caught in the pump. So just be careful where you go and where you do your research. So now, charting wise, there are various softwares out there. There's quite a lot of platforms. And JP has given one example there, tradingview.com. It's one of the trading platforms that is which is used quite a lot. So if you ever wondered why the prices can't be going up and down past certain zones, these zones are called support and resistance zones. And we're going to discuss that shortly. So at these prices zones, buyers see the stock is getting too expensive to buy. That's creating a resistance. And conversely, when sellers think the price is too low to sell, the price will stall around this area. And this in turn creating it into support. So support is a price level where a downtrend can be expected to pause due to a concentration of demand or buying interest. Whether the price is halted by support or resistance level, or it breaks through, traders can bet on the direction and quickly determine if they are correct. So you need to know this zone. And then there's the resistance level. So this is the point on a price chart when an upward price trajectory is impeded by an overwhelming inclination to sell the asset. If a market price is nearly a resistance level, a trader may opt to close their position, take the profit, rather than risk the price falling back. So at times you've noticed that stocks will bounce downwards when they reach that level. So they reach that price, maybe 5.8 every time, comes down again, reaches that, comes down again. So that's the resistance. So there's some resistance there. So most people refer to support and resistance as a single price point. However, in reality, there are zones. So there's a price range. Support or resistance can change role, and support can become resistance if price falls before the zone, and conversely, resistance can become support when price moves above the zone. So the more you draw these lines, the more you'll understand this term. So what does it look like really on the charts? So we're going to look at several examples here. So support zones on the chart are usually noted as 3 or more historical points where price comes back to during a pullback. The more points the price comes to, the stronger support level it will be. So this is also known as major or key support levels. So how does this look like on a chart? We've got an example here. We've got APT, Afterpay, the buy now, pay later. I think everyone knows about that one now. So as you can see, various support levels have been identified there, and some buyers would have come through. I can see the MACD line there. So buyers would have come in through there, bought, and they sold there, brought it down. There's another support line identified there. And as you can see, we've got 1, 2, 3, 4, 5. The first one was the key support there. It did dip in March. I think that was March last year because of this COVID thing. But since then, it's bounced right up again there. Because I remember when ATP was Afterpay. Let's just call it Afterpay. APT it is, yeah, not ATP. APT was trading at about $10 or something, and instead of buying, of course, we were scared. But anyway, the price has since gone right up, shot right up, and quite expensive stock at present. So you can actually see the support zones right there. When it was coming there, buyers will come in, take it right up. It will consolidate around certain prices. Buyers will come again when it gets to support, and they'll take it right back up. So that's the support level there when the buyers were coming in. And then the resistance on the chart. So resistance zones on a chart are usually noted as 3 or more historical points where price tries to get past during an upward move. The more points the price hits at a particular level, the stronger the resistance level will be. This is also known as a major key resistance level. So let's see what it looks like on the charts. So as you can see there, we've got APT again as a very good example. It's $28.76. Resistance was a hit. That was the first one there. It went up to another resistance was 34, around 34, $37, and another one at around 50. So as you can see, the price was being hit, comes back down, bounces up again, comes back down, bounces up again. So these are the resistance. This is the resistance that we're talking about. And what you can do now, you can go into TradingView. If you can sign up, normally the account is free. We're not being paid for this, by the way. We're just actually trying to identify, where you can go and you can draw. And normally you just have to go into indicators, click certain things, and then you'll be able to start drawing this. So find 5 stocks, draw your support and resistance lines, like we've said. So also study how the price behaves around these areas as well. So now we're just going to talk about trading strategy here. So as with any business operations, as we know, you need a strategy. So you can't just go in there blindly and, just be doing guesswork. You need to have a strategy. So there are more than 1.5 million different trading strategies out there, loads of them. And there's no right or wrong answer, to be quite honest. So in reality, it depends with the individual perceptions, really. What are you looking for? Are you short-terming? Are you day trading? Are you long-term? And what really works for you? So today we're just going to talk about, trend following method. One of the entry strategy is called the breakout entry. So this breakout entry method requires 2 important things: the Fibonacci tools and good eyes to spot the resistance and support zones. So that's what we're talking about today. So how does it work? So before we begin to dive into the strategy, the Fibonacci, we've just explained a bit about the Fibonacci levels. So these Fibonacci retracements are popular among technical traders. They are based on key numbers identified by the mathematician Leonardo Fibonacci in the 13th century. So this is a sequence of numbers, and it's not important really to know the relationship, the formula. The other time I cracked my head trying to, get to understand it, but I did in the end. I had to, read more on it. But it's not important really to know the formula and how those percentages come. So in TA, the Fibonacci retracement is created by taking 2 extreme points, usually a peak and a trough, on a stock chart, and dividing the vertical distance by the key Fibonacci ratios of 23.6%, 38.2%, 50%, 61.8%, 78.6%, and 100%. Once these levels are identified, horizontal lines are drawn and used to identify the possible support and the resistance levels. So the 61.8 and the 78.6 levels are also known as the golden ratios. So at times when you get in at this level with whatever price the stock will be, you may actually execute a good trade and make some money from it. So how does Fibonacci look like on the chart and how do you draw it? So if you go into TradingView, there's a Fibonacci tool already available. So to find out the Fibonacci retracement level after a move up, start from the lowest point of a price movement and drag to the highest point. Conversely, to find out the Fibonacci retracement level after a move down, start from the highest point and drag it down to the lowest point. We're just going to show you an example here. So we're going to look at a Z1P chart, and these are real stocks which are on the ASX, of course, and how to draw these levels. Notice how the price behaves around the 61.8 there. So as you can see, clicked on the lowest point, which is highlighted there, the first one, and then drag and click on the highest point, which is about $10.64. The lowest point was $1.05. So if you were going to get in around 61.8%, you can see clearly there that the price was going up there. It was quite safe to get in every time it got there as well, and you would have made money really. And so this is what it's just trying to explain there. So this breakout entry method, it relies on the follow-up after a stock experiences a move down, and then try to rebound off the base after testing the closest resistance zone. The entry points are usually around 50%, 61.8%, 78.6% Fibonacci levels. These levels may become a higher probability entry if the levels happen to coincide with the support area. So how does it work? So identify the potential resistance zone closest to the base, which we did mention before. Watch if a price is testing the resistance zone, and then wait for the price to pull back to 50%, 61.8%, or 78.6% Fib levels as support. So when you hear people saying Fib is the Fibonacci that we're just talking about. So breakout method. So there's an example there. So you can see the potential resistance area, which is highlighted right at the beginning, and the other one there, two of them. And then the price moves down, you can actually see there. And you can see where the line has been drawn right at the lowest point, going to the highest point. And you can see where the price found support, and it did that at around 50% to 61.8%. So you can not really say safe entry, but at that point, if you actually get in, that is RNU, for example, that has been used. RNU is actually trading on the ASX, graphite and other commodities involved with this stock because it's going into battery, graphite, anode. So just read more about that. So anyway, back to the chart again here. So it could have been actually a good entry to get in there. And if you look at that, that was like 1.3 cents. And yesterday this stock got to 8.3 cents. So that's RNU. So you can actually see how this can help you trading using this breakout entry method. So if you practice it more, you'll actually make some, money using it. So what you can do, you can go and get some charts, look into TradingView, find support and resistance line, draw the Fibonacci levels, and note them on the chart. And you can also identify the potential breakout entries, because this will help you. So this is just another trading strategy because there are loads of them out there. So I hope this has helped many people that are trying to find their entry points, their exit points. So that's the end of the presentation, and we'll see you on Twitter. So follow JP Gpunk on Twitter. So it's JEPUNK PUNK on Twitter. And you can also find him on TradingView because he does post some charts as well. So all the best with the trading and don't panic. Thank you.